I'm back with my podcast after 1 year, and I have with me Akarsh Jain. And today we're going to talk about stocks, the Indian stock market, the and how this 18-year-old, 17-year-old invests and his investment strategy and with the mindset he invests. And we'll also discuss the major topics when it comes to stock market, like that come to your head, like Ambani, Adani, Tata, public and private sector companies. And also, we'll be covering a brief segment on green hydrogen because I personally want to cover green hydrogen because that is, for me, the future for India's economic and environmental, both economic and environmental sustainability. So, with Akash, I recorded an episode approximately 8 months ago. And the thing happened was that the audio didn't come through. The video came, but the audio didn't. And I could not post that video. So I could obviously not post that content. And I just hope that this time we record both of them. and so let's begin. So
Yeah,
Akash,
sure.
how's your investing journey going on right now?
To correct you first, I'm 16, not 17, 18. You've
Sorry.
mentioned me bit.
Better.
Mhm. Yeah, that definitely is better. So yeah, investing journey has been going great. Learning a couple of things here and there every now and then. That's a good thing. That's a plus point investing. Again, all knowledge here is cumulative. So if I'm reading something anywhere, it just adds up somewhere or the other in the end.
Yeah, so the fact that you said that you're 16, that means you're not using your own PAN card because you need to be 18 to invest in this.
Yeah, so how it works is that, there are occasions in every Indian household, like Diwali, birthdays, and etc., etc., and you have relatives come to you, give you gifts. So I
Yeah.
have told every relative of mine, look, I'm not going to accept any gift apart from check. Even if you want to give me 1 rupee, you do it by a check. So that
Oh
check
my
comes in, it goes into my bank account. It goes into my bank account, and then it gets transferred to my dad's bank account, and then it is transferred from my dad's demat account. So if you look at my dad's demat account, it's just my portfolio, just my stocks. He doesn't do anything. It's just there. As on paper, it's his, but I'm the one behind it.
I guess this is sort of a motivation for everyone that, I mean, people say, a lot of my friends have said that first I'll turn 18, and when I turn 18, I'll start investing. And that was the same with me. And the fact that you're investing at 16 with no income source except your own relatives, and the fact that you don't have a PAN card to invest, you cannot have a demat account, but you're using your father's, should show that if you genuinely are ready to put in the work and you're genuinely interested and in making a long term wealth, then you can take any approach like the way you did.
So,
No source
so
of income, no actual source of income, no job, just your relatives. So yeah, that's
see, eventually, obviously, it's good, if you acquire a skill and you have a good source of income and then start investing. But for me, it was the other way around, because, I wanted to explore this field. And what I found out was, so again, right, let's say if you want to go into cricket or football, the first person you look up to are the greats, the legends. You want to go into cricket, you look at Virat Kohli or what Sachin Tendulkar did or how they used to practice, etc. So I did the same. I looked at Warren Buffett. People regard him as the greatest investor of our time. And I found out, that he had bought his first stock at age 11. And, so I was like, why not? Why be so late to the, journey? So I did that. The main intention was to eliminate all mistakes, make tons of mistakes right now, so that those mistakes shouldn't be repeated in the future. Perhaps when hopefully I'm managing more money, so that my investment mistake in quantitative terms is not a big loss. And another reason is, again, I'm young, I have time as an advantage. If I start early, again, I have an advantage over my peers. So, why not just go with it? So that was the main ideology behind starting it. And then coming to compounding came into the picture, So to give you, let's say, a number, let's say if you double your wealth every 3.5 years, so that's about 26 odd percent compounded per year. So how much do you think it's going to be in 10 years? So it's doubling every 3 years, 3.5 years. How much do you think your money will be after 10 years? Any guess?
Approximately 9 times, 8 times.
Approximately. So 26%, it's 10 times. Every 3 years, the money is doubling. In 10 years, it's 10 times. In 20 years, it's 100 times. In 30 years, it's 1,000 times. So just imagine, let's say if I start something 10 years earlier, I'm reaching that 30-year period 10 years earlier. So the difference is not, 10, 20, 30, it's 10, 100,000. So that's the exponential snowball that I saw. That is also one of the reasons. Yeah.
But it's quite difficult. Like, all right, first let's go to the fact that Warren Buffett started at 11 and at 92, I guess he's still running.
Yeah.
And in this survival and compounding play a very big role. And you say that in 3.5 years your money doubles, and then in 10 years your money goes 10x, 8x, 9x, 10x, being on the optimistic side. So but this is in the scenario where you're able to invest even during recession, in the worst economic time periods, when you have that kind of wealth available that you can put in your that you that you have that discipline over the longer period of time. So you reap the benefits of the compounding when you're surviving with for a longer period of time and with consistency. So instead of me getting a 66% return in 1 week or in 1 month, but for a very short period of time, like if I'm investing for only 3 years, that's not building wealth for me. But if I get like small returns for like 10 to 12% over a period of 80 years, that's what Warren Buffett wealth means.
Yeah, so again, right, 26% is actually a big number. That was achieved, So I believe in Buffett started, initially the first 10, 20 years he used to compound at 40, 50% a year. As soon, his pie got larger and larger, he started that compounding return started to decrease. So, I think till 2000, it was compounding at 1970, 2000, about at 26%. And, since that, when you'll see his returns has actually decreased. I think in the past 10 years, if you see, it's, I think, less than 15% compounded. But, eventually, when you look at his entire career at Berkshire specifically, he's going to complete about 58 years now in Berkshire. During that 58-year tenure, he's compounded at about roughly 20%, so that is a big, big number. And yeah, you are correct. You need to be consistent. But what we have seen even in Buffett's case is that 3-4 years is gonna be average, or let's say negative return or something. Then there's gonna be 2-3 years when the market will realize, oh, your holdings are being undervalued. Let's price them correctly. And that's the moment you get those bumper returns, 40%, 50% a year. And eventually, like, it's a bumpy road. It's not a steady road. It's an up and down graph, like how you have parabolas, local maxima, local minima.
Yeah.
So it's like that, but in an increasing manner. So eventually, again, that's why we say, buy and forget, just hold, hold, hold. Because eventually you make the real money making isn't there. So yeah.
When you say buy and hold, you remember I told you about my ITC. I forgot about ITC.
Yeah.
In 3 months, for 3-4 months, I opened my Upstocks account after 4 months, and I see that ITC is up by 40,000 rupees. It's a 44% gain.
Yeah.
And if I hadn't bought more stocks, if I was on like lesser amount, it would be an 88, 90% gain for me. But the fact that I bought more after that, it was a 40% gain. But if the percentage return might be like half of it, but the amount that I profited was a lot more.
Yeah, so eventually, like, that's how compounding works. Now, for example, let's say, as I mentioned, right, I have a portfolio, close to, again, 1.5 lakh rupees. When I look at that money, right, let's say if I'm earning 10% on it, that's just 15,000 rupees. Let's say there's a guy, who has 10 crore rupees in his portfolio. He's earning 10% on it. He's making 1 CR. So eventually that quantitative difference comes in. That's why we say, that your first $100,000 or your first crore or your first $1 million is actually a bitch. You have to work way hard for that. Then after that, it gets easier and easier and easier. For that first hitting that first century or the first $100,000, it's just damn hard. So yeah.
Yeah. I just want I just am thinking about that strategy, that how to take a 1 lakh portfolio to a 1 CR portfolio.
It's a long, it's a very, it's a 100x if you think about it
Yeah.
from compounding terms. It's a 100x. So if you want to get it in 20 years, you have to compound at 26% a year. Now that's what the best do. And it's hard for them as well, because even Buffett is not right every time, in his
Yeah.
career, right about 60-70% time. But that's frankly all you need. You just need a few big bets to mature, and you've made a lot of money. Like for example, on Apple, he's made, I think, north of 100 billion at this point. He bought it in back in 2017. It's worth more than $100 billion at this point now. So yeah, you just need a few bets to make you a lot of money.
Yeah. So one of the things that we discussed is consistency and survival and compounding. This is one major concept, that these three are concepts that
Hmm.
come under one major concept. Other is that you just need a few wins, a few big wins to even cover up your small losers.
Yeah. So what happens, I think with every investor's portfolio is that long-term investors portfolio is that, let's say, you and I today, we select 5 stocks together. One of it might go to zero, one of it might not perform. 2 or 3 of them will perform averagely or as per expectation, 10-12% a year. One stock will perform beyond expectations. And sometimes it's 1 in 5, 1 in 10. But eventually that gain, again, as you said, is so big that it can easily offset your losses and still give you a decent return.
Yeah, so basically it's like, this is something that's mentioned in the book Psychology of Money. And in that, there was this thing that it's not just for stocks, it's for everything. It's for businesses, it's for politics, it's for governments. Walt Disney was famous for his animated films, but he was about to he was losing a lot of money on his animated films. He made hundreds of films, hundreds of cartoons. But what was successful and what made his entire wealth, his fame was because of those hundreds of cartoons, but his wealth was because of those 86 minutes of Snow White and the Seven Dwarfs. He just needed
Yep.
one big win, otherwise he was just losing money.
Using exactly.
Same with
Mm.
Amazon. Amazon had a this is, I'm taking directly from that book, Psychology of Money. Amazon had a Fire phone, and it was a big loser. And and Jeff Bezos in an AGM said that if you think this is a loser, just know that we are working on even bigger losers over a period of time. And Amazon had a lot, hundreds of initiatives, and they were big losers. But what was even bigger was the win that was given by AWS and Prime.
Exactly.
Yeah.
You just, again, it's quite simple. In life, you just need a couple few winners and you're set.
Yeah.
So yeah.
So let's talk about your portfolio. Like, what have you held before, and what are you holding right now?
Yeah. So starting, I so my investing strategy has quite changed over a period of time. Initially, it was buying cheap companies, in the sense, what is actually referred to as cigar butt investing, where, let's say you buy a company, you look at its assets and you look, oh, the company is selling less for, let's say, its book value, or has more cash on, its balance sheet and selling less than it. So it was initially that. So I used to look for these cheap companies everywhere. Initially, I started with that. One of my biggest wins actually came that way. It was a company called Majesco. So funny story. My first multi-bagger was actually Majesco. So funny story was that this company that sold its operations to USA. Some company in USA. The stock was at about 100 rupees a share. And these guys, whatever money they got back, they were like, okay, we're distributing everything to shareholders. So the dividend came out to be $1,000 a share. Now the stock is at 100, dividend is 1,000. Everyone bought it. It went till 1,000, right? The moment dividend was paid out, so there's a system in the market, right? So whatever amount you pay the dividend by, the next day your stock price gets cuts by it. So the next day it went to a lower circuit, down from $1,000 a share to I think about $15 a share. And so that's the time I started studying it. And what I found out was, by the time I had made a bet, I think I bought it around 30, 35 rupees a share. By the time I'd made that bet was, I realized, that the market cap of the company was roughly 60, 70 crore rupees. At that time, it was, I could buy the entire company at 60, 70 crore rupees. The entire balance sheet was zero, 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 null, null, very small things. But they had real estate in USA, in LA, which was worth 200 crores, and they were planning to liquidate it. And now it came to me, okay, look, if that 200 crore rupees were to be liquidated and to be distributed among shareholders, let's say not even 200, 150, I'd still make a gain on it. I think I held it on for like 2 months. In 2 months, it went 3x. And then it was like, I know that, it's a cheap company. It's come to its fair value. Just get rid of it. So yeah, that was my first multi-bagger, 3x in roughly 2 odd months. Then the strategy changed to a bit towards earning power. That's the time I bought. Probably my one of my biggest bets initially was KRBL rice, which is a manufacturer of India Gate basmati rice. So the theory behind it was, you got a good quality business, dominant in its industry, best financial ratios, best efficiency, management looks solid, etc. And selling again dirt cheap compared to what its earnings were. That was a time of COVID, so everyone was also distressed. There was a lot of uncertainty. But again, right, rice as is a commodity business, and everyone's going to eat rice. They were the monopoly, in the Indian market, had the highest market share. Not monopoly, but you could say like a monopoly.
Yeah.
So, and they had the pricing power, which was the biggest thing, biggest factor. And then again, India Gate is a big brand. So, put money in that. First month, again, this was a very patient, right? First month, it was down by a third, 33% I was down. You know, Eventually, when we came to 6 months, I was up about 70, 80%. But then I sold it because I was reading through their financials. There was this annual report that comes out for every company each year, and something just didn't seem right regarding their accounts. So side by side I did little bit of accounts, and something just didn't feel right. Then I think 2 weeks later news came out, that their director is involved in some money laundering case. So
Yeah.
I was lucky that I got out. I mean, from now, I think the stock is actually appreciated again. It it would have just been a gamble. Then the ideology completely changed to, buying quality businesses, buying clean businesses, that have clean books. Because in India, there's a tendency of companies to launder money, save taxes, evade taxes, etc. So then it changed to, you want to look at great businesses, you want to hold them forever with, management doing a solid work. Then it shifted to that framework. So that's the time, when after Russia Ukraine happened, the IT sector was really depressed. The prices tanked so heavily. You had growth companies who were growing at 15, 20, 25% a year, selling at roughly 50% of what they were literally 3 months back, something like that, at multiples of 15, 20, three multiples of 15, 20. And the best part was these companies were generating a lot of free cash flow. They're generating a lot of cash. And so I took that moment. That's the time I think I put every single rupee I had in my portfolio into a company called Mastech. I mean, according to me, they were a very dominant in the IT industry, because in IT, there are few competitive advantages that one can have. It's either talent or the ability to execute larger deals. These guys came up. They bought a company versus from Oracle, and they said, "Look, we're gonna sell our services as a bundle. We're gonna buy more companies. We're gonna like form a bundle. So for example, Mastech will provide its services. They're gonna take Evosys's services. They're gonna sell that with Mastech services. Like a mixture, like a bundle. And so that held them in account mining. So let's say they had a 10 million pound client initially. Now they would go back to that client. Well, look, we've got more services we can offer you that can increase your efficiency, reduce your costs. Let's renegotiate the deal. So they would offer them more services, and that 10 million would go to 15 million, etc., etc. And then they have a pretty good business in the UK. So about 60% of the business came to UK. They were going to expand in USA, so they bought 2 3 companies. And the manager, Hiral Chandana, the CEO, he had his vision, in believing in efficiency, because he knew, I mean, there's an opportunity cost of doing everything. So they wanted to focus on bigger accounts, bigger account mining. So that's what, stood them out for me. That's the time I put a lot of money in them. And then, I think last year and after this, 3 months ago, I was again just casually reading news. I come across this bank called IDFC First Bank, and I was looking at it. Analyzed it. Great bank, great manager. Probably the best CASA ratios at all. And the best part is, this bank is growing earnings at 20, 20, 30% a year. It's growing a lot, and it's again probably because of the growth in loan book. But the thing is, it was selling at a P of multiple of 15. This was damn cheap. So I bought a lot of it. And again, it's a quality bank. So it was like everything in one. So without thinking, I bought this stock as well. Yeah, that has, give or take, has been the journey.
What did you mean when you said a multiple of 15? What was it selling at a multiple of?
So a multiple of 15 is, so when I refer to multiple, I'm referring to the P ratio, which is a price to earnings
Okay,
multiple.
yeah, price to
So when
earnings.
you look at, yeah, so when you've got a company that's growing its earnings at 25, 30% a year, selling at P of multiple of 15, that means right now, if you were to buy the company, you'd get roughly 7% yield, which is what you would get in a FD. But the catch is this 7% would increase by 20, 30% every year as you go on. And obviously this rate would decline, but it will still continue increasing if the bank does well. And again, bank's performance is mainly it aligns mainly with how your manager is, how the CEO has his vision, etc. And this guy has actually turned around the bank. It was a loss making bank, and they have the best CASA ratios now in the country. So yeah,
So that means your bet
that
is
was a
on the CEO solely, has been on the CEO.
it is solely on the CEO. I believe, all financial institutions, when you're making a bet, you're making on the guy, because again, if you like, ICICI Bank had a former CEO, I don't remember her name. She was involved in a Videocon case, money laundering case. And HDFC, Aditya Puri is the guy behind HDFC Bank. The rise, the success of it. So I believe, again, managers do play a crucial role in every business, but I believe with financial institutions and with IT, these service oriented businesses, managers have a more, like, they play a slightly greater role than, in product companies. So, yeah.
Let's rewind to KRBL. You remember you had told me about KRBL
Hmm.
around Feb 2022 when
Yep.
we were working on the T Golf competition.
Not, I think it was 21. I had 21, 22. I don't remember.
I guess end of 21, beginning of 22, something
Could be,
like
could
that.
be, yeah, could be, yeah. Yeah.
So because I remember that was like my last year in school.
Hmm, hmm, hmm.
Yeah. And at that time, the stock, if I pull it up right now, the stock was at a 195 approximately. I guess.
Yeah, I remember my buying price of 182 rupees per share.
Yeah, it was 185, 195, sorry. And
Yeah,
the thing that happened was you told me a lot of its fundamentals, the management, the export business,
yeah,
how large it was, the
yeah,
finance. And then when I finally set out to buy KRBL in I guess October 22, or I guess before that only, I you told me that you've sold it. You don't like
yeah,
stock because of this, because you feel like that the company is
yeah.
doing well.
There was some, yeah, in accounts. Yep.
And then after that, the news came out to be true.
Yeah,
That's the deal. The news came out
yeah,
to be true, but it was more of a shorter term play. Like if it was
yep,
a bank, then that would have been a long term impact, like what happened with Yes Bank, what happened with
yep,
PMC.
yep,
But with a rice exporting company, this is a short term play. With banks and with services, it's a long term thing that the manager was corrupt, the manager was doing money laundering, the top guy was doing money laundering. But here it's like it's a rice export business. Its fundamentals are good. The management can be replaced any day, but the export network is fundamental. At that
Hmm.
point, I didn't understand this. I went with your bet and I did not invest. I had the chance of investing. I even reconsidered when it was around 220.
Hmm.
Today, guess what the stock price is?
It's gonna be roughly around 350, something like that.
340.
Again, I took a good. I was lucky, when I exited, I exited at 300 rupees a share. In 6 months, 180 to 300. It was a good thing. But
Yeah.
again, things like this are hard to predict.
Yeah.
It's quite hard to predict. So I would like to make bets, where odds are in my favor. And as for the network, you said yes, definitely they have a very strong network. But at that point of time, when I compare, let's say, a rice business with, let's say Mastech at this point of time, for every rupee KRBL was putting it back into the business, they were for every 100 rupees they were reinvesting back into KRBL. At that point of time, they were generating 12, 13 rupees worth of earnings. In Mastech, this number was in 20s. So that's where your management efficiency comes into play, how your industry efficiency comes into play. So eventually, you realize, oh, KRBL was a good business, but Mastech is a great business,
Yeah.
and that's the
Mass
difference.
might be better. But if you solely look at KRBL and if you see about management can be replaced any day. If
Hmm.
if the management is corrupt, if the top guy is corrupt, he can be replaced. The company is bigger than him, and the new guy can easily come and sort the company issues out, because it's not because money laundering is not directly affecting the consumers or clients. In a bank, it is because
Hmm.
it's the people's money. But when
Hmm.
it comes to a rice business, the worst thing that can happen is that the price of the rice can be inflated, and that too,
Hmm.
the government of India will regulate it.
Hmm.
When it comes to this rice business again, it's India Gate basmati rice. I don't care if it gets 10% more expensive. Its brand value is so good that even if it's 10% more expensive and there is a price competitor out in the market, I would prefer India Gate.
So
Same with
the
photos. If
yeah
I see
the
today an India Gate basmati rice here in Australia, I would buy it, and even if it's $10 more expensive than the Australian rice.
the main reason is that, again, as you said, right, it probably won't have not. It's because it's a rice company, did not have that much of an impact. What lost me, like the thing that that made me lose trust in KRB was actually because I lost trust in management. There's a good chance that even previous numbers could have been cooked. So in a nutshell, I'm looking at a financial sheet or looking at the accounts, and I really don't know whether it's true or not. That was the main issue. That was the main concern. Because I'm like, I know the management is not transparent over a money laundering thing. There are high chances, that even previous year books, which I was using to evaluate, let's say when I, made this bet, when I bought the stock, could have been cooked, or in years to come, if the management stays, they can still might cook books. Because that's actually a really common practice in India. You have a lot of promoters cooking their books up. Satyam Computers was a classic example, a big one, India's largest IT firm that went bust in 2000s. I think 2007, 8, 10, something like that. So yeah, even in that case, they had cooked up the books. So again, it was more of that issue, that I did not have trust in management for the long term. So that
Yeah,
was that what made me sell.
logical. That's logical. But yeah, that's logical. And even I found that logical when we talked about, but now that both of us have like gained a little more knowledge and mature a little bit, we can see that these consumer facing companies, these direct to consumer products, like we ourselves see India Gate
Mm-hmm.
KRBL products, and we know about the product and how good it is, how strong its brand is, what brand value it holds, what value it's provide to the customers, the market share. We directly see it. HDFC, yes, bank had a very good was a very good bank, but we could not directly see what's going on. I mean, they might be give good interest rates,
Yep.
but there's some issue, and if there's an issue with the management, your money is directly affected. Here, I might be paying extra, but I am getting value that I am getting at the end of the day.
Hmm. So again, it's hard to say because it's one of those examples, where you really don't know the reasoning behind it. I mean, even when I see it right now, when people say, "Oh, you missed it," you could have gotten a 20% more appreciation on it. I mean, I still, like if I would have gotten that, it would have been probably gamble. So one of the stocks that I missed was I had bought Trident, and so this is a stock I had bought it at 13 rupees a share, and again it looked very cheap to me, and as my ideology changed, I sold it at 14 rupees a share. I was like, look, I am putting my money into some other stock, a better quality business. That stock, I think at its high in the past 2 years, I think went till 50 or 50, like it was a four bagger, and I missed it by a good margin. And if I would have held on to it, if I could say, yeah, agar, if I would have held on to it, my portfolio probably would have been doubled at this point of time. So
Yes.
again, I mean, I don't regret it because there was a logical reasoning behind it, and I sold it. If I would have holding on to it, I would it you could have called it beginner's luck. Again, as I said, right, this is a time where I want to make a lot of mistakes so that after when I'm managing more money out there in world, out there in future, I'm not making these type of mistakes again.
True. I mean, the stock went up till 64. I
Yep,
was still
exactly.
buying that stock at 64. It's down at 33 today.
See,
But the thing is that the that if you see about Trident, it's sort of a small stock, and you bought it at a very undervalued price. I bought it at a very overvalued price,
hmm,
and 32 is like the average it's been running for a lot of time. But still, if you can like pull up a little about Trident, it's also a good company because of the towels and bed sheets it sells and the quality of the textiles it provides. I'm just betting on it as a business because I'm one of its consumers. And if you see, the company has 100% buy rating. It's
hmm.
when you see the investment checklist of these six things: equity returns, dividend returns, the safety factor because it's there. These three are not there. These three are not met. It just gives a dividend of 0.36 rupees 36 paisa, and it's not safe because it's like very volatile. Yeah.
See, the thing with dividends is that giving out dividends, I wouldn't say it should be considered as a metric of whether it's a good investment or not. For example, because dividends are technically earnings you're distributing to the shareholders. Now, if I could go to Trident, let's say if I'm the manager of Trident, I'm the CEO of Trident, I would look at, okay, let's say, can these earnings be reinvested back into the business at a greater rate that would, let's say, benefit the shareholders? For example, when you look at Berkshire's history, Berkshire Hathaway, Buffett's company, in the past 65 years, they haven't paid out a single dividend, not a single dividend. And they own, they're the largest private individual shareholder of Apple. They own Kraft Heinz, own 10% of Coke. He's got a $300 billion portfolio, 150 in cash, something like that. What he does is he buybacks his own stock. So that's a good way of wealth creation. Again, right? You're distributing those gains to shareholders. Now, as a manager, you have to see, okay, is this money worthwhile reinvesting back into my business? Can I perhaps reinvest it at 15%, 20%, rather than giving it back to shareholders, let's say a dividend yield of 2%, 3%. And the other volatility factor is that volatility will remain. Volatility is no metric for the safety thing. Risk is not volatility. So Buffett has this quote called "risk is knowing, not knowing what you're doing," and which is actually quite true. For example, as I told you, right, KRBL that I had bought it. First week it was down. I remember, first week it was down by 33%. I remember one third of my portfolio going down. I still held on to it, because at that point of time, again, I thought, okay, look, the fundamentals are correct. It's just a downward trend in the market. Let me just hold on to it. because it's like you would evaluate a business's performance. You should evaluate a business's performance by what are the earnings growth look like, what how much cash is business generating, do they have debt or not, how much debt are they repaying, what is the return on capital invested, what return on equity, how is the management seeing things in the future, is there anything to be prepared for, any precautions, any provisions to be taken off, rather than how the market is valuing the price, or how the market is valuing the business. Because the difference between what market sees and what you see is actually where you make the money. Now, market perhaps might look at a business and say, okay, you know what, this business will generate 5% earnings growth for the next 10 years. You come and you say, look, I think I know this business a little bit better. I think this can generate 10-15% better returns. So the market will now price it according to 5% in earnings growth. You have bought it at 10-15% earnings growth. And let's say, your estimates are met in that range. Let's say, the business in the next 10 years gives a compounded annual earnings growth of 10%, 12%. Obviously, market is going to reevaluate, and reprice the business. That's why, when you look at some of very highly quality businesses like Nestle, Colgate, when you look at their Asian Paints, Titan, when you look at their P ratios, they're damn expensive. Because, market knows, like, it's okay, this is a very safe bet. We know, this is gonna give earnings of 15-20% a year for the next 10 years. And so it's mainly that discrepancy between the market's estimate and your estimate where you make a lot of money. So yeah.
That's the thing. If I'm not an investment banker, if I'm just a retail investor, huh? If you're planning to be an investment banker, but I am not. I am just a retail investor, and I cannot afford the services of an investment banker. I don't have that much capital to invest. Then, how do I understand this difference, the discrepancy that you're talking about?
So the thing is, again, it's like, as you said, that how you believe in Trident being a great business, right? I felt that, I understand Mastech better than Trident. It's all about, see, it's a game, it's like a test match, the bowler is Mr. Market. He's gonna come, he's gonna bowl balls at you, and in test matches we see, that the batsman actually leaves the good balls. You don't have to hit every ball, so you don't have to hit on every bet. I mean, I have looked at probably till now, till date, I've analyzed 500 companies. I've probably understood 30 of them. And out of those 30, I've probably made bets on 5, 6 of them because I found them at the right price. So again, for me, I don't have to, play every ball. Whenever I think, the bowler is burning a full toss or a bad delivery that I can hit it out of the park, I'm going to go and step on and hit it for a 6 or a 4. So it's all about, again, as we say, it's about taking big bets, big bold bets. That's how you make money. But at the same time, subsequently, you have to make sure when you're making these big bold bets, the odds are in your favor. We have this graph that we're taught, that high risk equates to high return. And the thing is, these opportunities are everywhere. So what you have to look is, you have to look for these abnormal opportunities where the risk is low but the return is greater. Like, for example, I said as Majesco again, where I was my first multi-bagger, 3x, was a clear example of where the risk was damn low, but the return, potential return was actually higher. And this will not work every time, but it's going to work most of the time. And it's going to be in your favor. And again, eventually, your winners will offset your losers and you'll make a lot of money. And again, right, so let's say now you're going to CS blockchain, I believe, right?
Yeah.
So you as a person might know more than me in CS or blockchain. So perhaps you might just invest in those companies. You might wait because you'll have a better view of how the future of a certain company looks, how the fundamentals of a certain business looks compared to, let's say, what should be. What would define a great business in that particular industry, or what would a future earning power of the business would look. And if you just stay in your circle of competence, in this case CS blockchain, and you just buy undervalued companies from time to time and just hold them, you're going to make a lot of money. Again, back to the point, I don't have to hit every ball. I can just leave the ball and let it go to the wicket keeper.
Yeah.
So yeah, so that's, again, even I don't have those services. I just read annual reports, I read general news. Again, it's, I don't have to make every bet. So for example, there was this company I've been looking for since 6 months now called Balaji Means. It's a chemical company, specialty chemicals. It's a very oligopolistic industry. And I was studying it, trying to understand it for 6 months. Then IDFC First Bank came. It took me 5 hours to make that decision. The it took me 1 year to make a decision for Mastec. It took me 5 hours for to IDFC First Bank. It took me 3 hours to make it for Majesco. It took me 3 months for KRBL. So, it takes time to understand certain things. The simpler the business to you, the better you understand it, the better advantage you have over the market. Because, a lot of people here, they don't, who are buying, who are retail investors or traders, they don't really go into the depths of fundamentals or how the core of the business. But essentially, that's the logical thing to do. So yeah.
All right. So it's not about making all the buys, it's about just knowing like the ones you have best knowledge with,
Yeah,
the
so
ones you need to calculate
yeah,
it.
exactly. So for example, when I am nowadays when I'm looking at a company, it's not like what's good about it. It's the reverse. What's bad about it? The moment I see a red flag, rejected, next, rejected, next, rejected,
But
next.
you
It,
need to take some potential to like you need to give it some scope. Like if the company is very good, it has a good PE ratio, it has a very cheap PE ratio, like of 6.
See, the thing with PE ratio is that PE ratio is backwards. So when I say, okay, I bought IDFC First Bank at a multiple of 15, that meant, last year's earnings, I'm buying the company over 15 times last year's earnings. Eventually, it's about the future of the business. I mean, for example, let's take a look at Lehman Brothers, right? In '05, you could have said, oh, let me buy Lehman Brothers at a multiple of 1. You would have still lost money because it went bankrupt. So mainly it's about future earnings. How is the business going to do well in future? Whether it's going to, even you look at cases like Amazon and everything, you'll figure out, in 2015, 14, 13, these companies had a multiple probably more than 100, 200. Now it's stagnatized. It's, I think, pretty sure it's in double digits somewhere around. The P ratio has actually fallen quite a bit, but they've given returns, and it's only possible because of the increase in earnings, because that has compensated for the fall in P ratio. So again, eventually, it's about the future potential or perspectives of the business, as you said. So
All
yeah,
right. So it's not just about how the business has been, it's also about the future
yeah.
possibility.
Whatever past has been is the past, right? I mean, you look at the newspaper industry, internet came and disrupted it completely. And you have to evaluate, you have to think it from a view, from, okay, 10 years from now, how the picture is going to look like, 15 years from now, even 5 years from now. And the best part is, if you have an idea, when you have a clarity in mind, that this is something, even some clarity, that's the time that you've done your research, you've done your due diligence, and you can make a bet if you want to. So
Yeah,
yeah.
so I was saying that I don't understand a lot of this ratios game. I'm yet to gain.
So yeah, I'll in simple terms. Okay, let's say you have a stock, you buy a stock which is at a multiple of 80, P ratio of multiple 80. That means last year's the past 12 months, whatever the earnings have been, you're paying 80 times for it. And let's say in the next 10 years, earnings grow by 8 times, or 23% a year CAGR. So earnings are 8x now in the next 10 years. And let's say in the next 10 years, in year 10, after you've bought it, the P ratio has actually fallen from 80 to 40. So that means there's actually, your investment returns will actually be, divided by 2, because the business is not now being valued at 80 times, it's being valued at 40 times the earnings. So when you look at even from that perspective, you figure out, that you're still making 4x,
How's
because so you got a 22%, 20 to 23% earnings per year CAGR for 10 years. And then in 10 years, your P is halving. So that would equate to a 7% decrease return every year. So when you figure out the net, it's about 15% compounded every year, net return. And when you do that compound math, you figure out, that you're still making 4x your money here. So even at high P ratios, even at high P ratios, it's not necessary, that, oh, this company is bad or overvalued. It all depends on the future. Like if you, I mean, I think if you would ask me, IDFC First Bank is, I don't know, I think it's 2022 PE ratio at this point of time. I would buy it even at the 30 PE ratio. It looks cheap to me. compared to its future prospects. I'm even ready to buy it at a 40 PE ratio, because again, the next 10 years, what I see through what the IDFC First Bank will do. I mean, I believe even 40x would be cheap for it. Yeah.
All right. What do you say about a company that has a PE ratio of 6 or 7,
Hmm.
but a debt to equity ratio of 9 to 10? And I know that this company has a lot of revenue coming in over the next at least 10 years because of the orders it has in place, because of the contracts that it has in place. And that contract is worth billions of dollars.
So you have to, okay, now if this is an infrastructure company, or let's say if
Financing
it's a
company.
business, see, if it's a finance, if it's like an NBFC or a financing company, having a debt to equity ratio of, again, above than equity is quite normal. It's considered a great metric if obviously it's under 1, but above 1 it's considered quite normal. I'm pretty sure this company is then, let's say, in its expansion phase. You have to, because it's now a financing company, when you have a look, okay, what asset quality and net interest margin of this NBFC or this financing company is going to look good, and you have faith in the manager, you should make the bet. Subsequently, if this was, let's say, an infrastructure company or some other business, I would have asked, okay, how much free cash flow are they generating? Because what happens is that, on paper, you're making money. On paper, let's say you can make
Free
profit, but
cash
if you
flow,
don't
you
have
mean
cash on,
retained profits, right?
no.
Then
So free cash flow is the cash a business generates in a nutshell. So for example, when I look at airlines, for example, or let's take an idea example of Airtel or Vodafone, these companies, could, I think on paper, can easily make profits, but they don't have cash in the bank. Now, for example, airline, it's a very poor business because, yeah, there are a lot of costs, every 20-25 days is fuel, there's rent, etc., etc. And they just end up with no free cash flow. In the sense, they don't end up having cash in the bank. Now, for on paper, profit might be 100 crore rupees, but free cash flow just might be 10 crores, 15 crore rupees. And the thing is, if you don't have enough free cash flow, if you're not generating cash, that's the time you start taking debt to finance, to make sure your working capital cycle, resumes smoothly. That is the time you start taking debt. So when you look at these big giants, Apple, TCS, Microsoft, Google, these guys, do a lot of share repurchases, share buybacks, they pay a lot of dividends, etc. Why? Only reason is because they have a lot of free cash flow. There's also why we call them as cash cow companies or cash rich
that
companies.
is possible. That is possible only if they have good retained profits over the period of time.
Yeah, so retain
The net
profits doesn't
cash
necessarily.
flow, if the net cash flow of the company is
Yeah,
good,
yeah. So so the again, if they're in, as I said, right, if I'm reinvesting my money at, let's say, at returns of 15-20%, and my cost of, let's say, investing that near cost of equity is 8-10%, so I'm making money on that. It's profitable for my business rather
yeah.
than giving that money out to dividends as dividends to shareholders. So yeah.
All right, let's move on to the next part. It's, I guess it's going to be a brief part. Ambani, Adani, Tata. Your most favorite, your
Money.
least favorite, and your opinions on all three.
My opinion on all three. Okay. I'd say Mukesh Ambani is a damn smart man. However, I have no clue how his succession plans are gonna be. That's one thing I'm worried about. Because again, I understand it's a family-owned business, but his his children might not be the ideal successors to him. I look at Adani. Adani is actually a good example. The stock prices have inflated quite a lot, but when you actually look at its ratios, so for every 100 rupees that Adani is putting into its business, they're just generating 4 to 5 rupees worth of profits and cash. And the thing is, in India, when you take a business loan, the cost of equity of taking in India is about 12-13%. Let's say for Mr. Adani, it's being reduced to 8%. Still, that means he's losing money. So I don't understand his math there, and we've also been involved in a lot of controversies. There's a US research firm coming in saying, making allegations. Tatas are perhaps again very noble. They're what I would say humble down to. I mean, I think that's also part of their goodwill. They're a very trusted and reputed brand value in India, and yeah, a lot of people admire Tatas. So yeah. Most favorite would be, again, out of these three would be the Tatas. Most least favorite would be Adani, because I have no idea what he's doing. And yeah, that is my opinion on all three of them.
Yeah, me too. Like Adani least favorite. I don't like his gearing. I don't like his the kind of debt that he's taken. To some extent, I believe that the Hindenburg report. I don't know what's in it.
See, honestly, I believe,
It's big controversy.
Yeah, Hindenburg is actually a very credible research company, so I would not doubt their findings or something.
Exactly. And but I like Adani's network, how he there was a when the Hindenburg report came out, there was a
Mm.
shorting what's the word? There's the
Yeah, short selling.
there's a lot of short selling going on. Yeah, there was a lot of short selling going on. But how Adani managed the situation, how his network allowed him to squeeze that short, that's very impressive. I might not
See,
like his business, but I like his network.
the thing about that, again, right? See, we talking about share prices, not the value behind it. Now, for example, the if I look at Berkshire Hathaway itself, in the history, they've clearly said, that we will only purchase Berkshire Hathaway shares, like we'll buy back those shares only when we feel the share is at a discount to the fair value that we think the company is worth. So, a lot of people actually get happy, when a great company stock tanks. If I could have told you, that, perhaps there's this great company, or let's say ICICI Bank, I remember after COVID was selling at 300 bucks a share. ICICI Bank, great bank, is probably the second largest bank in India. It's a too big to fail bank, and you would be like, oh, it's selling too damn cheap, 300 rupees a share. You'd actually be happy. You'll buy more rather than being worrying. And there was actually quite smart people in US as well. Whenever their stock is, when they believe it's overvalued, they tend to do deals in stock. That I'm planning to acquire you. I'll give you $5 billion worth of my stock. I'll pay through that. And when they feel it's undervalued, they buy back their own stock. So it's actually quite a smart thing. Again, this might get a bit controversial, but I believe the only see, Ambani has a competitive advantage of petrochemicals. Huge cash flow, huge cash cow, huge cash cow. Tatas have it from TCS, huge cash cow. Adani, the only competitive advantage I see with Adani, I mean, yeah, definitely is infrastructure network and everything, but the main one would perhaps be political backing. That's what I believe perhaps is his competitive advantage. Now the thing is, that's a very big external factor, not an internal factor. That's a factor I cannot control, or I cannot see or evaluate when I'm evaluating the businesses. So that's probably the reason why Adani as a whole group comes under a poor category for me,
I mean,
not even
if
a good category of business.
talk about political and the political moves and the business fundamentals and the financials and the networks, I guess a very more than this balance is more achieved by Ambani and Tata than by Adani. Adani might have a lot of
See the
political
thing,
power, but
yeah,
but
the
today I
thing,
would call
the thing,
but today if let me complete. Sorry. But
yeah.
today if Modi is the king, or if anyone else comes in power tomorrow after Modi when he retires, if anyone else comes in power, he'll be the king, he'll be the prime minister, but Ambani will be the kingmaker, and the kingmaker enjoys more than the king when it comes to politics. Ambani will always be there because Ambani is bigger than Adani any day.
So,
You,
so
you,
you
you
also,
in US in the state dinner you saw Ambani, not Adani.
yeah. So you also have to see that, when I compare the internal factors, or let's say not the external forces in a business. If I'm looking, oh, perhaps, like Reliance has a big petrochemical business, Tata's have TCS, Titan, great business, brilliant business, and then you look at Adani, hardly anything, that could perhaps make them stand out. It's at this point of time, we're just putting cash in. Obviously, it's needed for expansion. But again, you might doubt it. Now, again, these are the situations, when you have even a slight doubt in your mind, you don't make a bet. So you are looking at situations, you're finding those rare gems, those rare situations where you can actually make those big bold bets. So yeah.
But even Adani might have some plan of action ready if he has a lot of gearing, it's high risk. But he might have a plan of action in his head if he's taking a lot of risk in creating such a vast shipping network, such a vast port, like
See,
such a
no,
vast network
no,
of ports.
no doubt. He's come this way. He's probably smart enough, smarter than us. We just critiques here. But
Yeah.
what one thing we have to also realize is that, again, as I mentioned earlier, I don't have to hit every ball. If I feel, this ball might be a good ball, or it's going to be hard for me to judge the ball, I'm just going to let it go.
Yeah.
Thank you, next, please.
Right.
So, yeah.
He is a smart guy because if he wasn't, he wouldn't have gotten those first loans in the
Yeah,
first.
definitely.
He's
Yeah,
the doer,
definitely.
and
Definitely.
we just had to just put our opinions out, and we don't have any
Yeah, definitely.
to.
Yeah,
But yeah, but yeah, we have a lot to learn from all three of them, though.
absolutely. I mean, I'm not saying, he's dumb, he's idiot, he's dumb, brilliant guy. But again, I would not like, again, I will not be 100% 1% comfortable making a bet on him. I'd rather be happy owning something else. That's why, even when the stocks fell about 50%, I did not buy any of it. So
But
yeah.
if it came to the fact that I'm not getting any net profit, net income, like if I'm earning just enough to live within my means, but I get for 15 years, but I get 5 years with each with three of these, I would happily spend those 15 years of my life.
Yeah. No, no, again, right? You want to work with great people, you want to learn from them. You want to be the stupid, the most stupid person in the room. So they can, again, you
Yeah.
can learn a lot. So yeah, that's that's a wonderful approach.
Yes. And let's go to the green hydrogen game. We just talked about Reliance. We just talked about Tata. We just
Hmm.
talked about Adani. All three of them are in the green hydrogen game. If you look at the numbers, Reliance is putting in 5.95 lakh crore rupees for developing 100 gigawatt and renewable energy plant, 60,000 crore rupees in investment in PV storage, hydrogen tech, and 15,000
Hmm.
in partnership, future tech. Same with Adani, he's putting in $50 billion through his Adani New Industries Limited in green hydrogen and the ecosystems that are integrated to it over the next 10 years.
Hmm.
Same with Tata. What is Tata doing? Tata has invested 60,000 crore in renewable energy for the next 5 years. All of them are in the game. All of them are making moves. Reliance has made a move with its partnership with the Ashok Leyland with the truck that has an
Hmm.
ICE engine, but it runs on green hydrogen. Reliance has done some JV, I guess, with Streisand or something. You've got IOC. IOC is adding green hydrogen units at a lot of its
Hmm.
out at a lot of its petrol pumps and all. And it's also doing this business with Tata Motors to buy hydrogen fuel cell buses. So how do you think that will India be able to, because of the work of these giants, these three, along with L&T, IOC, Renew, these major businesses working together, will India be able to achieve its goal on a as a global superpower, global economic superpower because of green hydrogen? Because it's helping India reduce its imports by 1 lakh crore rupees, adding exports because a lot of countries have infrastructure issues like Japan. It doesn't have enough land to produce green hydrogen. Japan will have to do business with India. Japan has good tech, but it doesn't have land. We can these companies can harness India's natural resources as well here, and it's
Hmm.
leveling the field for those with those fossil fuel reserves?
So again, definitely, India is one of the favorites coming, in the upcoming decade to be a economical superpower. And I mean, when we compare India with other large economies, US right now has a big deficit problem. China, I would say similar, has some political issues as well within itself. And when we look at UK, we surpassed UK again, bit recessionary environment, but I think it's gonna be fine. But when we look at again, when we compare all the economies, we feel what I think, and a lot of economists as well, think that India is probably gonna be the favorite, like the favorites. Our economy is gonna grow, and the main reason behind is obviously, you've got a lot of investments coming in, as you said, from outside, from domestic as well. You've got a lot of Reliance, Tata's, Adani is putting a lot of money in India. So yeah, definitely, it's going to help increase your India's goal of. It's even it's even also going to increase your sustainability goal. It's going to help you reach it. It's going to
Def-
help you. It's going to help you reach it. But again, it's definitely going to increase incomes as well. But the main factor behind India's growth, I believe, will be consumption. So there is this theme that plays out. It's a report by Motilal Oswal. So what they showcased was that, if let's say you have $1,000 GDP per capita, you know, so $900 would go towards your needs, $100 towards your discretionary expenditure, ACs, etc. Like luxury things, cars, vehicles, etc. The moment this doubles, to $2,000, it means when you're adding $1 trillion to your economy, the moment this goes to 1,000 to $2,000 per capita, your needs, it increased by $100 again, right? How much more can one person consume after, even having a increase in their earnings? And the rest $1,000 will be left for consumer discretionary expenditure. So just by adding $1 trillion, just by increasing GDP per capita by $1,000, the consumer discretionary expenditure is actually going to increase by 10x from 100 to $1,000. So that main consumption, period, I believe, is going to be a bigger force. And I think the most companies or the biggest sectors that are going to benefit from this will be, again, as I said, your consumption sector, things like, let's say, your AC companies, your automobile companies, etc., etc. But I think, even the companies that are going to benefit more than this would be the IT sector and the financial sector. One thing, if you notice, when you go to, let's say, when you look at US, when you look at China, look at Singapore, UK, you figure out, that financials and IT tech, these guys play a crucial role in one's economy. So I believe, again, these guys will still be leaders. Hydrogen energy, again, is gonna be a massive contributor. But in the end, eventually, I believe, that it's gonna be financials and tech.
So even, I mean, yeah. So even finances and tech are profiting from green hydrogen. There are a lot of projects that need
Definitely.
financing. There are a lot of projects that need technology. And
Definitely.
so yeah, these two are the fundamental two sectors which are involved in every other sector. You need money, you need technology to work in any
See,
sector,
every sector
agriculture,
is
energy,
technically,
anything.
yeah, every sector is technically interdependent with,
Yeah.
every sector. But again, in a developing economy, when economy is going from a developing to developed state, the current state, because we're in a transitioning period now. Um, Again, financials and tech and your discretionary goods, these guys, benefit the most. So yeah.
And based on and what you said about the report, the GDP per capita doubling.
So yeah. So
All
yeah.
sorry.
Go on. Yeah.
I was just saying that all credit to Modi. That's happening. We're on the way to it. He's doing a great job with the economy. And you don't need to read the reports for that. You can see it live when you go to a mall. you see so many more people there. I mean, the rush. It wasn't
It's
there before COVID.
it's not even about that. It's also the fact, when you look at GST collections. So again, right, there's a global recession going on. US was in a recession, Chinese economy not doing so well, and everything. All your global players, kind of not doing well. You look at the GST collections that come in. You figure out, oh, it's increasing year on year, 10%, 12%. That means consumption is increasing. That means people are buying more, people are earning more. Again, basic economics. There's a multiplier effect that comes into play. And so even the UPI, introduction of UPI, the digitization of payments has helped a lot of business people. So for example, now you see is those chai walas. These guys are being more efficient. Their working capital cycle has increased, has actually shortened, so it's benefited them. Again, as we say, right, they're receiving cash at time, they're paying out in time, so there is no gap, where they have to take, let's say, yeah, they have to borrow money from someone to pay their expenses. They're being more efficient. So again, all credit to UPI, all credit to the reforms that the government has made. So yeah, no doubt, again, not taking the side, any political side here, but no doubt, there you like there are a lot of positive things happening in the economy, right?
I mean, yeah, again, if you look at it objectively, people shit on Modi for the demonetization and all his failed reforms, but their focus is on his failures. If you look at
See,
his
the what
wins,
demonetization actually happened is that there are two stories to look. There are two point of views when you look at demonetization. The first one is for the corporate people. People paying their taxes, not evading taxes, not doing anything in black. So obviously, right, execution was a bit messier at that point of time. Right now, they're trying to get 2,000 rupees out of the system, and the
yeah,
execution is going quite smoothly. So he's learned his lesson. So yeah, but I think eventually, the people who were earning in white did not have any problem with demonetization because they had a record for everything. You know, switch to the parallel economy, which plays again contributes to a big part of the Indian economy. It might be unorganized, might be unaccounted for, but a lot of households are run on it. I think majority of the households are run on the parallel economy. Those guys suffered a lot again because now you need to show, what is the source of the income. And when they find out, okay, look, you're evading taxes, eventually you have to pay that money. And the thing is, they haven't been doing this since a year or two. It's been going on since a quite long time. So the main thing was probably to get the black money out. So yeah, they've
and
demonetization actually. Sorry.
that was a success.
It was a success, definitely was a success. GDP has increased, poverty in absolute terms have decreased, GDP per
That's what
capita
I'm
has
saying.
increased.
People call it a failure because they don't see it, but they if they look at it again, they see that even if no one with black money came forward and paid more tax to conserve their money, there wasn't anything removed from the economy, and the people who did, they just added to the economy. They just
Yeah,
claimed
so
the money,
again,
and then the economy of India boosted in terms of
yeah,
the number.
absolutely, absolutely. Because again, the government is spending that back, is reinvesting that money in. So yeah, I mean, black money is still around. Again, as I said, there's always going to be a portion of the Indian economy being, dealing in black money, dealing in cash. But again, cash will stay for a while, in my opinion. But yeah, eventually, depending on the government, hopefully it goes out of the system. But yeah,
It's not just that, there are like a lot big wins that people can clearly see, and yet they try to put him down. Like in the
see,
public.
honestly, even I am not a Modi fan. I don't have a political side. But one thing again, I have to give him credit is that he's done.
Exactly.
The way the economy has been under him
I knew what
is
you were
actually
going to say
been.
before you said it.
Sorry.
I knew what you were going to say before you said it.
Yeah, exactly.
What about public versus private sector? Because we've been talking about Modi a lot right now. What about public or private sector?
I mean, a lot of public sector companies, when you look at their equity holding, you will see the president of India owns a big stake in it, or your big governments own a big stake in it. So eventually the incentive is to perhaps distribute the cash. That's why you'll see, right? IOC, ONGC, IRCTC, have very, very, big dividend yield because they're technically just distributing their cash out. So again, I mean, it could be a value play, but I would slightly go towards, I would actually bet on a company that's reinvesting their earnings and it's growing their earnings, from time to time. And so to give you an example, there was this company that sees candies, and I think Buffett had bought it in 60s or 70s, or I believe in 80s. And at that point of time, they had a revenue of about, I think, $25 million, and 18 million dollars, that a revenue back there in $18 million. They were making $2 million of profit, and Buffett paid 25 millions for the entire business at that point of time. Now, now it's 40-50 years later on. The volume growth, as in the number of candy they've expanded, but the number of candy they sold is just 2 to 4 times what they used to sell back in the day. But the amount of money they're making, the profit, is close to 100 or even more $1 million. The earnings have actually shot up more than 50-60 times. And when you look at C's, they have actually given Berkshire Hathaway $1 billion to $2 billion in profits now over its course of over Buffett's course of buying it. So again, you want a business like C's Candies, that's reinvesting its money into the business and growing it in a way. And at a point, when they know they cannot reinvest it at a good return, they're distributing cash back. So yeah.
I mean, these companies put a balance of the two, and I guess that's a perfect combination. Like, I want dividend yield, I want increase, I want
Eventually it comes, yeah. So eventually you have to
expansion,
understand, right? When
I
a
want a
company is
balance
in
of
its
both.
growing stage, yeah, when a company is in its growing stage, it's going to use all the cash. That's why they retain a lot of the cash, they invested in projects, and then there's going to be a point of time when these projects mature, they start producing cash, and that's the time company gets cash rich. So Apple, Amazon, Google, these companies are at the stage like this right now, when they're generating ton of cash, they have a lot of cash on hand, they can distribute it, they can retain it, and everything. That's a phase that comes later on the period. So yeah, like if we look at Buffett's Coke purchase, he's making, I think, 70 to 80% of his cost price in dividends now. He bought, I think, $1 billion worth of stake in Coke. Yeah, and now he's getting $780 million dividends every year. So again, he's held on to it, for the almost 30 odd years. But again, that's why we say buy and hold. That's patience. The game is all about just holding it and forgetting it. So yeah.
Buffett himself says that the stock market is all about taking the money from the impatient and giving it to the patient.
Yep. That's completely, because you're eventually buying a piece of a business. Now, when you buy a piece of a business, you don't sell it literally 5 minutes after or a day after. Or even when you buy, let's say, a property or a flat, you don't sell it a day later.
I mean,
So, yeah.
if you look at companies like IOC, if you look at IOC particularly, like you said, that it's a government company, it's a public sector company, it pays out dividends, it's good for dividend yield, and but it's not growing. But I clearly see IOC growing, not just on news, not just in TV when I watch the news, but also in terms of numbers. It has an EPS of 27, 26, and it's giving out dividends of 5 or 6. It's keeping its investors happy in both ways.
So
Giving
again, right? Given two options, it's like, okay, so if you were given two options, that ignore the dividends right now and get a better rate of return, let's say 20-25% CAGR after 10 years, or take the dividends right now and settle for a return of 12-15% a year for 10 years. For me, again, I'd choose the other option, 25%, because if I, again, that 10% itself makes a huge difference over a course of 10, 20, 30 years. So like I told you, right, in 30 years at 26%, your money is 1000x. If the same rate of return is 15%, your money is just 64 times. So yeah, that is a big difference now, 1000x and 64x.
Mhm. That makes
So yeah,
sense.
just a 10-11% difference per year can amount up to such a big difference.
What if I reinvest my money that I get from dividends?
Well, you do reinvest it, but again, right? I mean, if you know, again, it's all about opportunity cost, right? If I have five bets in front of me where I know, right, that three of them could potentially give me 20-25% CAGR over the next 10-15 years, and one could give me 12-15%, and all four, five of them have same probability, same odds. Why not bet big on those three which give me the highest return? Because eventually, again, this is a situation, the risk is similar, return in three of them is greater. Why not capitalize on that?
I'll tell you one thing that you'll make a damn good investment banker.
I don't want to become an investment banker.
What do you
Investment
want?
bankers are. I want to go into hedge funds mainly, asset management, etc. Investment banking is mainly,
As
okay,
a
you want
portfolio
an
man.
IPO. Yeah, you could say portfolio manager. Yeah,
Yeah.
you could say in a way.
If
Investment banking
I
is
if
more.
if I have enough wealth one day, you'll be handling my portfolio. But this is not a verbal
Yeah,
contract. Keep in mind.
yeah. This is definitely not a mobile
There is
contract.
no
Yeah, don't
legal
worry.
intention to follow this contract. It's not a contract.
Yeah. No issues, no issues. But yeah,
Otherwise, I get to know that the day I hit a $250,000 in my bank account, you're coming to me that we had a verbal contract.
no, nothing like that. I have had a lot of relatives, coming to me and be like, हमको, they call me up, यार, ये बताइए इस stock का क्या है, ये क्या है, ये क्या है. And the thing is, these guys get those tips from random people, some random engineering company, selling on the market. And I'm like, look, you open their accounts, you're gonna see a lot of mismatch, and then you'll want to stay away. Because again, 90% of businesses in India, they cook their books. 80,
Yeah.
90% of businesses in India cook their books. And the best part is, 70% of corporate profits, 60, 70% is taken by your Nifty 50, the top biggest 50 companies in India. So yeah.
You know what? I don't know if you watched this show, but you should watch this show, Billions. You will love it. It's for a guy like you.
I have watched it. I have watched it billions. I have watched billions. I prefer Succession more. There's
I
a
have
show called Succession.
watched it. What's it about?
Sorry?
What's it about? Succession.
Succession is about there's this big family. There's a big the billionaire family, media conglomerate. There is this dad on the top, and he has siblings. Now there needs to be a succession, and it's like a corporate war inside the family. It's a very thriller. Like everyone is backstabbing everyone for that throne, and the main person, the dad, is not ready to give it. So yeah.
So, just in case towards the end of it, you didn't think that this podcast added any value to it, just know that you got two more shows to watch to add to your watch list: Billions and Succession, which you will enjoy no matter how less interested you are in stock market, because it's a lot of drama in both.
Yeah, definitely.
but I,
Disclaimer:
but
don't
I'm
judge
sure that
us.
this added value to all our viewers.
Disclaimer: don't judge us by the show or movie recommendations that we give. Yeah,
Yeah, well, I have a movie reviewing podcast. So
yeah, I've seen it.
so
I have.
and you know what's quite coincidental? Today we are having this recording, and today one of our podcasters talked about reviving the podcast again after 6 months. Look at the coincidence.
Yeah. And
And
again, life is
yeah,
quite beautiful. It completes a full circle.
yeah.
So yeah,
So thank you so much, Akash, for giving your time. I guess it's approximately 1.5 hours that you gave to me.
yeah.
And I just
Thanks
hope
for
this
having me.
time it records.
Yeah,
Yes. Thank you so much. And I got to learn a
my
lot
pleasure.
about the ratios, especially the PE ratio, and what's how to evaluate good companies. Not much, not enough that I can make big deals, but enough for me to have that basic fundamental knowledge, which is a starting point, and that starting push against that inertia is very helpful. And I never cared about PE ratio. I have intelligent investor kept with me. I never cared about reading it because it's like very, very heavy, very
See, Intelligent
So
Investor is a brilliant book, but it's actually quite outdated. There are only two chapters. There's a chapter 8 and chapter 20, which are still relevant to this state. So one teaches about margin of safety, the other teaches about market volatility. So yeah.
yeah. So I mean, these terms are also explained there, and I never cared to read it because I got so bored by these terms. But you gave me that push against that inertia, and I'm very thankful to you for that. For that,
Well, again, it's investing is quite what I would say is common sense. You just buy something cheap, which is a great company, and you should let it grow. Just hold it on forever. It's simple but not easy. Mm, That's a better way to put it. It's quite simple. I mean, I haven't used calculus. I have never used even an Excel sheet to make a valuation decision. It's like, okay, this looks under. It's like, if a obese person comes into your room, you just have to guess whether is it above 100 kgs or below 100 kgs. And if let's say a sumo wrestler comes in your room, and you're like, definitely it's above 100 kgs. So you're making a bet that way that look, I even have a safety. So yeah, valuation also is that aspect. Never use calculus in valuation. Never use an Excel. Never even use the calculator. It's just a rough estimate. Because again, we are humans. We make errors. So yeah, you want to buy something. If you think something is worth $100, you want to buy it for $70 to have that, you know, slightly a margin of safety. So yeah, cushion, what one would call.
damn right. Thank you so much for giving your
My
time.
pleasure.
Your
Thanks for
knowledge
having me.
was a
Thanks
great.
for having me.
Thank you so much, Akash.
Thanks
And
for having me.
the end of our podcast, and I will soon be recording. I will soon be like downloading the recording and editing it and putting it out so that our viewers. I don't have many left, I guess. I had a few before, but I hope that over time that this is the
Yeah,
one that revives the podcast.
hopefully.
Thank you so much.
Thanks a lot for having me.